Hey there, Kenneth French of Vast Voice, telling business secrets to entrepreneurs. We're very, very happy you stopped by. Either you're going to watch this or listen to this because you want to take your business to the next level. You're probably an entrepreneur who's either just starting out or you've been around for quite a while and you want to take your business to the next level. You're probably a real estate investor, maybe even a real estate agent, maybe a professional or of some sort, professional advisor of some sort. And well, you are stopping by because you need some valuable advice from one of the top industry leaders there is. Anyway, thank you very much. Once again, Kenneth French, Vast Voice, telling business secrets to entrepreneurs. Really glad you stopped by.
Do you want to become a wealthy real estate entrepreneur? What's one way to do that? By legally cutting your taxes. Hey there, Kenneth French with vastsolutionsgroup.com. We've been invited to help you learn about ways that you could, well, cut your tax bill legally, ethically, and morally in such ways that you probably already could be doing, but just not employing any strategies now. We're going to go over the top 10 hacks to lowering tax liability for real estate entrepreneurs. Once again, Kenneth French, it is indeed a pleasure to be here and to be working with you to lower your tax liability in ethically, morally, etc. ways. So we're going to get right to it. I think this is a little funny. Cutting taxes. People talk about cutting taxes, don't really know, ways to do it. Even entrepreneurs who are, believe it or not, real estate slash also CPA or investors sometimes come to us here at vastsolutionsgroup.com. We work with a lot of professionals, a lot of tax attorneys, and a lot of financial advisors to help clients and even themselves to lower their tax liability. And we're going to get right into it. So what are we talking about today? We're going to be talking about, again, the top 10 easy tax hacks for real estate entrepreneurs. We're going to be doing it as a countdown. So it's going to go from 10 all the way to 1 with a bonus here at the end as far as the top 10 easy tax hacks for real estate entrepreneurs. And why does this matter? Once again, most real estate entrepreneurs overpay their taxes. They don't even realize they could be lowering their tax liability. Sometimes they're working on their own to lower their tax liability, or who knows, maybe they're working with a CPA who just doesn't know enough about the real estate world, or they just don't know because they're not taking a couple of minutes a month maybe to lower their tax liability. The IRS, by the way, is not going to call you and say, well, hey, you're paying too much in taxes. That's not the IRS's chief mandate, right? And by the way, this 45 minutes could save you, who knows, $5,000 or $50,000 per year based on this presentation. And by the way, my name is Kenneth French, once again, vastsolutionsgroup.com. We're a vastassetdefense.com company where we also work with a team of attorneys over at Asset Defense Team to work hand in hand. We at vastsolutionsgroup.com do tax, finance, artificial intelligence to lower tax liability. We've been doing artificial intelligence since at least 2018. We really started 2010. So we know a thing or two about lowering tax liability using artificial intelligence. A lot of people say I understand what's going on with artificial intelligence. I think we've been doing it a little bit longer than most people out there. And Asset Defense Team, led by attorney Bob Bloom, who knows a heck of a lot about asset protection, estate planning. I consider him the godfather to asset protection in the US. As you see, that's a picture of Bob, Lily Faulkner, who is our general manager here at vastsolutionsgroup.com, me, and also our team. So it's not just, Bob and Lily and myself, it's a big team who are helping us. We're a virtual team. We've been virtual since 2006. I took over in 2006. The company itself, vastsolutionsgroup.com, in a different name, has been around since 1969. As I mentioned, we do tax, finance, artificial intelligence to help entrepreneurs. And I've taken over. When I took over in 2006, we were just kind of a fledgling finance company working with insurance, investments, et cetera. But now we do a lot more, specifically working with entrepreneurs. I have a number of books out. I'm a former Forbes.com small business owner contributor. I'm an AI and tax contributor for the AI Journal. And I have a book coming out in just a little bit. Now, how to think like the wealthy, because that's really the key. You could be a wealthy person watching or listening to this, or you could be someone who's just starting out brand new in the entrepreneurial journey as far as real estate goes. But you have to think like the wealthy do. Now, I know it's going to be a change for you typically, right? It's tax planning, wealthy people do not guess. They strategize. They have strategies in place. So they're thinking proactively. Plus, by the way, they leverage the tax code. So it's all done legally, ethically, and morally. Most of the people out there are doing it legally, ethically, and morally. Wealthy people just have the means to be able to do it with a staff. And I'm going to go over some elements that are going to help you to do some tax strategies without having a huge staff, and really to automate it and make it, easy as it relates to tax liability. Um, you know, easy tax hack number 10. Again, we're going to go backwards, 10, 9, 8, etc. Easy tax hack number 10, setting up an LLC, a management corp, or an S corp. A lot of people don't realize having the right entity set up by an attorney who knows what's going on as far as asset protection can also help you with taxes. So many times I'll be working with, let's say, a real estate agent who, might be a well-heeled agent. Let's say they're making, I don't know, $1 million, and they're having all the assets, all the investments, all the money, I should say, going to their social security number because they're 1099. Simple. Set up an S corp, have a salary depending on the circumstances, have a low salary as long as it's market salary, and then you're paying a huge amount less in taxes because you've gotten the S corp set up hopefully correctly. So your salary is low. The difference between a salary, let's say a salary tax, and your total income tax, therefore, is a huge difference. You don't have to pay as much on call 'em dividends or earnings as you do in your S corp salary. That's just one strategy. There's a ton of strategies that all are determined by which entity you use specifically. That's put together usually by an attorney, sometimes by a CPA or what have you. Easy tax hack number 9. This one's pretty simple, actually. If you, let's say, you have two people who are W-2, and one who's deciding, I don't want to be a W-2. I want to become a real estate professional, work 750 hours as a real estate professional, if you will. Well, what happens is you can deduct all your real estate losses against active income, because if you're a W-2 income earner, it's active income. You want to change it so it's, well, passive, right? So one way of doing it, you have to meet 750 hours of working as a real estate professional, and which is, by the way, huge for high earners. So if you have one spouse who's, working at whatever, Microsoft, Google, or what have you, doesn't have to be a tech company, and you have another one who's, slowly branching out into real estate, if they're working 750 hours a year at least, and their principal work is real estate, you save a bunch of money. We're going to go into easy hack number 9. Let's just say Sarah makes $100,000 as a W-2. She has $25,000 in net real estate losses, depreciation as an example. And let's just say she's in the 24% tax bracket. So $25,000, which we said earlier, is in losses, real estate net losses, right? You've been a real estate investor, let's just say. And, well, again, you're in the 24% tax bracket. 25,000 times 24%, what is that? $6,000. By being a reps, let's say real estate professional, you get to save $6,000 right off the bat. Right off the bat. Now, $6,000 might not sound like enough, well, for you, depending on the circumstance, but let's just say you're making two, three, $400,000. That adds up. Plus, by the way, just think about it. Now you can invest that whatever, $6,000, $12,000, $18,000 into real estate. So it's free cash flow, and it's not that much work. It's an easy tax hack. Easy tax hack. All right. Now, what I would also say is consult with a professional. Make sure you're doing the right thing as it relates to your certain situation. Now, a lot of the stuff we're going to be talking about, well, let's remember, it might be perfect in general, but it really is determined by your specific situation. This is for educational purposes, as it were, with a lot of caveats. Want to make sure you're talking to the right professionals out there. And if you need any help, just go to our website at vastsolutionsgroup.com and we can help you. If you need some help, either from our perspective, or if you're working with a professional, we can work with your professional. And if your professional doesn't know some of these ideas, we can help you. Easy tack number 8, maximize depreciation. Thing called bonus depreciation or accelerated depreciation. Not going to go into the specifics of this, but it's one thing to talk to your professional advisor about. This can really help you. You could change the number of years you deduct, let's just say, or I should say, depreciate some of the chattels, let's say, in a property. Meaning, you could save some money and you can do it strategically that can lower your tax liability. This really is for your tax professional. So you really don't have to get into some of the specifics. Your tax professional can help you with this. Easy hack number 7. It's this one's way simple. Shift income strategically. If you have a son or daughter who's of a certain age, you could shift income to that family member who has a lower tax liability, and this can save you money. Or you can put a management company in place, or hold co, whatever you want to call it. Well, you can. This will also help with cash flow. So you could change some of the tax specifics because you're shifting income to an entity or to a family member. Also, in this case, use the tax code like a playbook. Ways around, or ways to establish shifting of income, will help you as it relates to the overall tax structure. The biggest thing here is, family payroll. If you're moving money, let's say to a child who's doing some, let's just say, modeling online as an example, let's just say they're getting paid whatever $15,000. They could put it into a Roth IRA. We're going to go into that some specifically. Or other ways, let's say they're working for your company, and son or daughter is working for your company, shift some income towards them. They could put money away. They're paying a lower taxes because they're making probably a little bit less than you would be as an entrepreneur. As an example, easy hack number 6. This one a lot of people don't know about. I'm going to go into this in a little bit more detail. People don't realize in some cases you can invest your IRAs, maybe even solo 401ks, solo profit sharing plan, solo defined benefit cash balance plan, into any of those vehicles and put it into real estate and invest. Let's say in a self-directed IRA, individual retirement arrangement. Let's say you're having a rollover, you're working in a 401k, you roll over and do a self-directed IRA. You could put whatever, $200,000-$300,000 into, let's say, real estate investments, and actually usually increase your rate of return better than you would be able to than you know, in stock market, as an example. Plus, you're buying it tax deferred, or if it's in a Roth IRA, it's tax free going forward as long as you're abiding by all the rules, regs, etc. It's cool in that some people, I get it, by the way. Some people want to invest in the market, meaning the stock market, but some people want to invest in real estate. This is a tax hack because, man, if you buy a piece of real estate for, let's say, in a Roth IRA for, I don't know, $50,000 as an example, just pretending, and it goes up 200,000. If it's in a self-directed, let's say a Roth IRA, you don't have to pay taxes on it. You pull the money out tax free. That's a huge run up. Let's say in a qualified plan, traditional, let's say IRA, traditional 401k, you would have to pay taxes on it. In this way, you don't have to. Makes it really nice. That's a tax strategy a lot of people don't use that they should. That hence the reason easy tax hack number 6. Now, what I would also say, you can do investments in your, let's say, Roth IRA, your solo, traditional 401k, et cetera, and invest alongside other individuals. Or you can, by the way, you can even do loans out of your plan to other investors, i.e., hard money loans. And it's in the qualified plan wrapper, meaning it's tax favored, let's just say. So what I would also say is, you're going to have to know some of the specifics. Some of this could get a little bit more detailed, but the general element is, do investments sometimes in a qualified plan, in a self-directed, or let's say self-directed IRA, self-directed Roth IRA, or whatever the case is, because it's tax neutral. It's tax beneficial in the long run, but it's tax neutral whenever you're doing, let's just say, an investment in a piece of real estate. It's not, or a rollover, because it doesn't discount you in any way. So it's usually net beneficial to do investments in your qualified plan, that being, self-directed IRA, traditional 401k, et cetera, et cetera. It's nice because you have access. Usually people have money in a self-directed, let's say, IRA, that they could be doing a lot of stuff with and are not. So easy hack number 6, pretty, what I would say is one that really needs to be taken care of much more so than it is. And sometimes, by the way, we hear, well, my financial advisor does not want me to do self-directed investments. I get it, because they usually, the compliance arm for financial advisors can only do so much. They can't look at every single, asset people are putting into, because then they have to do the compliance. It is a lot of work. But what I would also say is, if you're going to take assets into your own hands, well, you're going to have to get involved a little bit. And one thing to do is do the research on your own. If you're one of those people who wants to do the research on your own of the project, and you really think it's going to go north, going to go up, maybe it makes sense to do self-directed investments, that specifically being usually real estate, as far as in your IRA, or by the way, or crypto. By the way, we were one of the first crypto, or we were supposedly, according to Gemini, we were the first to allow crypto in defined benefit plans, which is pretty cool. All right, easy hack number 5: deduct travel the right way. A lot of people miss this, and this one's so simple. Well, you've probably, if you listen very well to the easy hack number 10, now what you're doing is, meaning, putting together LLCs, S corps, management corps, et cetera, et cetera. If you're doing it correctly, you're going to have an entity for each enterprise, for maybe even for each, let's say, property as an example. So you're billing it correctly. That's one thing that we haven't even gotten into the specifics yet. But anyway, what I would say is, let's just say for one LLC, you're flying from Washington State, where we are headquartered here at vastsolutionsgroup.com, to, let's just say as an example, Florida. You're doing it for an LLC. You have a credit card, hopefully connected to that LLC. Well, that makes it simple for bookkeeping, by the way. But what you're going to be able to do is deduct some of your travel, your lodging, your meals, your rental car, your gas, et cetera, et cetera. Okay. People don't do that. People do it to their own social security number. They think it's deductible. It makes it harder to deduct that way. Plus, it's not as clean, which we're going to get into in just a little bit. Same thing for seminars and conferences. Seminars and conferences can be deducted. Oh my gosh, why wouldn't you make it deductible? It's the IRS basically saying, here, we're going to help you to grow your business. And what happens is you lower your tax liability as a result. Same with due diligence trips. Let's say you're in Washington. You want to look at a property in Florida. Deduct it. Deduct it. You got to deduct it, right? The government's giving you money. And then, of course, you have to do proper documentation. You can work with a CPA or a tax professional to get that done. Easy hack number 4: clean finances. I mentioned earlier that, to have clean finances, good proper paperwork in order, it will help you as an entrepreneur to know that, if, as an example, your assets are well invested where they should be and getting you the most money as far as rate of return. So nowadays, there's AI bookkeeping tools that makes it very nice for you as an entrepreneur. Clean finances, you know where your assets are going, you know where your investments are going, you know what your rate of return is, you know what your, cash on cash rate of return is. It's nice now with all the bookkeeping that's out there, specifically tailored to entrepreneurs, and specifically artificial intelligence bookkeeping tools that are now out there for entrepreneurs, specifically real estate investors. Clean records, optimize taxes. The cleaner your records, as I've mentioned, you can optimize taxes as it relates to, your investments, et cetera. Plus, by the way, clean finance also save time and reduces errors. Plus, in the net, you're paying less in taxes. Now, I'm going to go over one thing that I think is beneficial. If you're not using, AI for your software, we have software package that's free, FREE. We're going to be talking about it at the end. It's free, vastbookie.ai. People can use it free. You don't have to pay for Quicken. You don't have to pay for QuickBooks. Plus, you don't have to pay for, I hate to say this, but you don't have to pay for a bookkeeper. Lower levels, because the AI that's embedded into that software, it's automatic. Right? You don't have to do any categorization, et cetera, et cetera. It's easy. It's much easier, and it's all automated. No need for a bookkeeper, no need for QuickBooks, and it's tailored specifically for real estate investors. So we're going to get into that in a little bit. All right, easy hack number 3: know your short-term versus long-term capital gains, or I should say gains. Flipping is ordinary income tax. Now, I'm not going to say flipping, meaning, buying a house and then selling it 2 weeks or a month later, as an example. That's flipping. So whatever your ordinary income tax rate is, meaning for the year, that's what you pay in taxes. If you have a high tax rate and you're doing lots of flipping, you're going to have even a higher tax liability as a result. Now, I'm not going to say it's bad, because we deal with a lot of flippers, but at the same time, you're going to have higher net tax costs as a result. Rentals, they're passive, plus you get depreciation. Income from rental properties is considered passive income and can be offset by depreciation deductions, like we talked about. So long term is very good, generally speaking, as far as your tax liability. Usually you split, if you're working with a good attorney, you split your short term into long term capital gains, meaning the entities as far as the structure as well. Now, one thing to note, you've got to make sure that you're tracking all your short-term capital gains, so you're not ending up getting surprised when your April 15th rolls around. Right? Right when you go into a deal, by the way, you should plug that into the system and know what your tax liability is going to be, Because if you, let's say, project a whatever $100,000 gain based on short term because you're flipping, you want to know that now when you're getting the deal. So you got to calculate that in to your deal. Okay. Also, there's a way to, believe it or not, this is a big deal. There's for short-term capital gains or long-term, either one. There's this thing called installment sale 253A. You can potentially do a strategy that can lower your tax liability because you're spreading out your tax liability. Something to think about. It's a huge deal. A lot of people don't think about it. It's advanced, but it's something to at least think about. So easy hack number 3, think about installment sales if you're doing either short-term flips or long-term capital gain strategies, either one. Easy hack number 2, home office plus vehicle. A lot of people don't think about this. This is really important. So, and as long as you're taking care of the IRS rules, you can do a home office deduction. Basically, claim a portion of your home, which you're using for business purposes. Just follow the IRS rules and guidelines. Usually, this can save you really right off the bat thousands of dollars. And it does not take much time for you. It's an easy one, right? Also, Section 179, you can deduct expenses um, for your car. Pretty simple. Your CPA, your tax professional can help you, or you can visit us at vastsolutionsgroup.com if you need some help. And usually it's small changes that can equal big write-offs or big cost savings. That's the best way to say it. And it doesn't take much time. These are easy hacks, very easy hacks for you to think about. Um, and why wouldn't you? If you're really using, let's just say, one of our clients is using a huge garage, his own garage on his property, using this huge garage. Well, he's getting money back from the government because, well, before his tax advisor didn't tell him to use the home office deduction, but now he's going to do it, and it's going to save him tons of money because it's a big percentage of the overall house. Easy hack number 1: the biggest thing is have a proactive tax plan in place. Do it proactively. You have to have at the beginning of the year, earliest possible moment, get a tax plan in place so you know what to do going forward. We've been using artificial intelligence to lower tax liability for our clients. So what we do is we project forward, our system projects forward and then works backwards to limit the tax liability to the extent possible. We don't want to be in one of those groups. April 15th comes, here, this is your tax liability to our clients. No, what we want to do is catch it early, know what it is now, and then plan backwards, figuring out what the tax liability is going to be and figure out what you need to do in advance. Now, what I would also say is some systems are coming online, but they're not AI oriented. In our belief, it's better to do it artificial intelligence oriented because then the system learns what it is that you're doing. Now, what I would also say is number 2, stick with the tax plan. Whatever your tax plan is, stick with it. Come back frequently to double check with that you're in line with that tax plan as far as cash flow, et cetera, et cetera. This one's easy. It's more technical than it sounds, but it's easy because, getting a tax plan in place and then sticking to the plan, it just takes, let's say, on a quarterly basis, you're doing this. It will save you money. I'm willing to promise you it will save you money. Do a real plan that's proactive and then stick with the plan and keep coming back to it ever so often. And let's just say it takes you throwing this together. Let's just say it takes an hour, a quarter, let's just say. Well, that hour, whatever your time is, let's say your time is worth, I'm making this up, $50 an hour. You will save $50 an hour for that hour by having a real tax plan, a proactive plan, and then checking with that every so often. Let's talk about one more. This is a bonus hack nobody thinks about. It's worth you spending this 45 minutes or an hour during this presentation to think about. It's a bonus hack. Research and development tax credits, or R&D tax credits, sometimes they're just called R tax credits. If you're doing any AI innovation whatsoever, it can be various different types of innovation, almost automatically, the federal government will give you tax credits. If you're doing things that are innovative, you're trying new things in your business, you can get tax credits back from the government. If you're already doing it, well, why not just then do the application? It's not even an application, it's a filing with the government, so you get money back. It's tax credits, it's not a deduction. It's better. I'm not going to get into the specifics. It's better than a deduction, as a matter of fact, because it's basically dollar for dollar tax credits. By the way, both sides of the aisle, Republicans, Democrats, like tax credits and R&D tax credits because it puts money in the pockets of business owners, big and small, farmers, et cetera, et cetera. Now, also, not only federal tax credits, but also state tax credits. You get state tax credits based on the fact that you've done the application usually with the federal government, depends on your state. Even if your state doesn't have taxation at the state level, you still can get state tax credits. We have clients all over the country, Florida as an example, and a lot of our clients, or a good number of our clients, I should say, also are getting money back from Florida as a result of state credits. Now, what I would also say, tax credit intel is a huge it's the number one site for R&D tax credits. I would go there for resources. We have some on our website, by the way, as far as resources, but also go to taxcreditintel.com. Taxcreditintel.com. You'll find a bunch of resources for business owners, and which will go into some of the specifics. I'm willing to bet you, if you're doing anything as far as AI, Chat GPT is an example, Gemini, Claude, Perplexity, any of those, you're doing something innovative for your business, you could be getting back money for the government. This is a huge hole in the repertoire of tax professionals. All right, real quickly, we're going to go over the vast way, as we'll call it here for this presentation, 10 tax hacks. We've gone over reps, 750 hours of, putting time to real estate entities. Make sure your entities are correct. That could save you money, especially if you're going to go. Why would you want to go, if we call it naked, with no entities? Because then you're open to lawsuits, can't save money on taxes nearly as much, etc. Depreciation. Don't forget depreciation. You'll be glad that you remembered depreciation. Income shifting money to different, let's say, different members of your family or different entities. It can lower your tax liability. It's an easy tax hack. Self-directed investing. Roth IRAs are a huge way of lowering tax liability. And I'm going to remind you, all these things are legal, ethical, and moral. Travel, everyone forgets this for board meetings, property tours, seminars, due diligence trips, this as an example. Bookkeeping, I would say use AI powered, but use tools that are out there to keep your money and finances clean, exactly how they should be clean. Asset classification, understand the difference between short and long term, maybe even use I put 1031s, but really use strategies that can help kind of postpone income taxes, because money saved now is better than money saved later. Home and auto, make sure you're at least thinking about IRS compliant home office deductions, maybe 280A Augusta rule, et cetera. And then the biggest thing, be proactive in your planning, be proactive with your taxes, spend a little time. It will come back many times over. And the bonus we went over, AI. If you're using any AI, you're getting back money from usually the federal government or the state government. Either way, you're getting money back. Couple things to think about. We're going to throw out one thing, or actually really two things. If you're looking for tax reduction, we're putting together a package specifically here. vastsolutionsgroup.com costs $1,495. Tax strategy roadmap for your situation. You're going to have free bookkeeping. We're going to, I've alluded to twice about the bookkeeping. Free AI powered bookkeeping, $199 a month value for 1 year. 1 year, you don't have to worry about your bookkeeper, paying for bookkeeper, or typically software as it relates to your real estate investments. But it could be for any business, but it's really suited for real estate investors. Have access to our vast vault. It's a community of people, as an example, who are basically doing some of the same things you are doing as a real estate investor. And some of the resources there, you'd see $1 Billion Resource by Jay Cron, who started Kajabi.com, his co-founder. And what I would say is, if you're there's no better person as far as a resource, as far as community building, because a lot of people are now starting communities as far as the real estate investor groups are going. And this guy knows exactly what he's talking about. Jay Cron, or Jonathan Cronstad, he's part of our Vast Vault community, and he wrote $1 Billion Bullseye, and here Rich Dad Poor Dad. We've partnered up with Sharon Lecter. We do some joint speaking. She is co-author, as you can see here, CPA, Rich Dad Poor Dad. She's really the one who got me they're really into entrepreneurship. What I should also say is the tax reduction package is also reviewed by a licensed professional. If you decide you want both taxes and asset protection, Bob over there at Asset Defense Team, or I should say vastassetdefense.com, in this context, he will put together an asset protection strategy roadmap for you. You get one LLC as a result, and you get his free Vast Cares Extended Maintenance Program, normally $895 for a year. You get it free, and everything in the tax and asset protection shield package, it's reviewed by a licensed attorney, that being really Bob Bloom. And again, I mentioned that he's, the godfather of asset protection in the United States. He really is. I mean, he's been around. It's funny that he's hanging out with us. He's been around for a long time. He knows exactly what he's doing as far as asset protection. He's one of the big time attorneys he's taken think of this. He's taken the stages with, Margaret Thatcher, with, even Ronald Reagan, Obama. He's been on some big name stages talking about some of the things that impact business owners in a big way. So why work with us? We work with real estate investors across the country. We really have been doing AI for years. Everyone's talking about AI. We use AI tools to a certain extent. No, I almost said to a certain extent. I would say better than anyone in the marketplace as far as tax with respect to real estate. We have, thousands of clients. We've been around since 1969. We have a proven track record, and a Google review rating that's really good. I'm going to remind you about our community. It's worth reminding, our community of Vast Vault, you know, join us, $199 per month, limited time. We're offering it free. And what I would say is, it's all real estate investors. It's all for people who are, trying to, trying to run a business that's, tax basically favored. So people could save money as far as taxes, not overpay taxes. One last note, modernmillions.ai book that I'm coming out with. If you join the community, there's going to be a ton of resources that are going to be coming out of that community of people who are involved in the community, specifically as it relates to the book. And I'm going to have a number of resources that are helpful to the business owner. Now, there's one more thing I want to say about the community, and really the magic behind the community. It's tough in today's world. We know it. We get it as entrepreneurs. We're entrepreneurs putting together this stuff for you as an entrepreneur. But if you're in it to win it, if you're in it with entrepreneurs who are, similarly focused, they've, put together their LLCs, they've watched a number of resources just like what you've watched and listened to as it relates to the top 10 easy tax hacks, you'll be working with people who understand your language, who are helping you to take your business to the next level, who are helping you to lower your tax liability. I mean, where are you going to get people like, Sharon Lechter, Jonathan Cronstad, millionaire matchmaker, Laurel Langmeyer, who are helping you to take your business to the next level. In here, if you join by buying any of these products and services that we talked about earlier, either the tax reduction package or the shield, as protection shield, we're all going to be walking the same path, and you're going to get some ideas out of that community. There aren't many tax strategists that have over 800 people in their paid community. That's a paid community. We have over 800 people who are, driving along, not alone, but they have other people in the van who are helping them to get to the point that they want to get to. What's the next step? Go to vastsolutionsgroup.com, vastsolutionsgroup.com. You'll be very glad you did, because some of the resources are going to be there. They're going to help you. And then you can sign up for, contact us, and you can learn a little bit more about, our services, and specifically the ones that we talked about, or any of the things we talked about, modernmillions.ai, my book that's coming out, or, whatever, tax hack number 5, tax hack number 4, whatever the case is. What I would also say is thank you for taking the time to spend that you've spent here with us. Again, go to vastsolutionsgroup.com. It's VAST solutions with an S group.com. Again, vastsolutionsgroup.com. We're here to help you as an entrepreneur. We love that you've spent the time taking, the amount of time you've taken has been huge, and hopefully it's been helpful. And man, what I could say is I'm excited you've taken the time here. If you have any questions, please do go ahead and reach out to us. Info@vastsolutionsgroup.com. Info@vastsolutionsgroup.com.